Anyway, so it is March 6th already. The bears have awakened in Steamboat Springs. I haven't seen them yet, but once they're out, spring is just around the corner and they're hungry. They're little guys, right? Barry Bailey, they're not nothing to worry about. Uh, we're happy to have you here at the Edge Live demo and discussion. And I've got Brian Wilson, market strategist, back with us today. So he's going to take the first half. I'll take whatever remains. And I've got important things to cover, and I know that he does too because we talked about it. So without wasting any more time, over to you, Brian.
Thank you. I appreciate it. Good to see everyone again. Just as an FYI, I expect that my wife is probably going to come home in the next couple of minutes, and I think my dogs will probably respond to that. So if we get, an echo in the background, it's just the puppies excited that mom is home. Well, I did want to cover just a couple of topics, and a couple of them will kind of dovetail with some things that Tim has been discussing, and he'll probably have an add-on as well. I'm going to start with a topic that I touched on with this morning's note, and that is SPY sentiment. So I'll go ahead and share my screen. We'll move over to Edge data for a second here, and just pull up SPY to give you an example. So if you look at SPY over time, and we'll just take a look at this, we'll start with a one year look. I've got a couple of slides to show you. Generally, SPY, obviously measuring the S&P 500, roughly 90% of market cap. It's generally neutral. It's the exception when SPY is not at 5, and we're looking at data here during the last year. You can see that it's dipped below 5 3 times, and it's been above 5 4 different times. So that's the exception when it's either above or below that neutral sentiment reading. That being said, let me take this all the way back for a second, and it'll be hard to read, but there's a method to my madness, and then I'll show you. I'll break it out in a slide deck. So this is going back to 2017 when our data set originated. What you can see, it's a little hard to read, but we hit ones in 2018 a few times. We hit one during the pandemic, and then we hit a bunch of ones during 2022. That's kind of the big picture from an SPY sentiment reading. Let me break that out, and you'll be able to see it better here. So SPY sentiment trends. We'll start off with 2018. S&P 500 returned about negative 6% that year. You can see that we hit one, looks like 4 different times during the course of the year. Generally speaking, a sentiment of 1 is just not a good outcome in a bear market. You can see how the market was declining there for the space of about a couple of months. We got a little bit of relief. Market was at neutral for a long time. And then once we started to hit 1 again, you can see that the market moved lower. Take a look at 2022. Similar outcome. We were hitting 1 a little bit more often, and I can hear my wife just coming in. And so far, the puppies are quiet, so we'll take it. So we're hitting 1 consistently during 2022, and you can see the downturns in the market. Let's see, what did we do? 3, 4, 5, 6 different times during the course of the year. The takeaway here, you hit 1, and the market in a bear market generally continues to fall under those conditions. You can see we will have periods of brief upside. You can see that upside there. You can see upside here. But over time, when sentiment is weak, being expressed in SPY fully oversold at 1, conditions are difficult. Take a look at the last couple of years for a change in that. So 2023, nowhere during the course of the year did we hit 1 sentiment, and we had a raging, bull market. The lowest reading we had was 1.8. and that was at the end of October, right in here. Generally speaking, during a bull market, when sentiment gets weaker, that becomes a buying opportunity. Obviously, as I just showed you, that's not the case in a bear market. 2024, almost identical. The lowest reading was right here. That was 2.6 in early August. Once again, a buying opportunity there. So it's the difference, right, between a bear and a bull market. Which way do we go this year? Who knows? I don't know. There's a pretty strong likelihood, though, that we probably hit a one sentiment reading maybe today. We'll obviously have the details for you tomorrow. I did this slide deck yesterday. That was 2.6 as of the 4th. That was 1.8 as of yesterday. So that sentiment reading continues to slide. So just wanted to share that with you. Once again, which way do we go this year? I don't know, but I'd have to uh, side a little bit with the 2018 or 2022 scenarios. It really looks, like we're going to hit, 1 out of 10 fairly soon. In that type of market environment, if you want to trade daily, the daily trading ideas, what's the best way to go? Low volatility. Tim has mentioned that in a couple of recent notes. You can see today, here's your 5 choices. If you look at what they're doing today, this is today's momentum choices, by the way. Here's the low volatility choices. Three are down, 2 are up. It's just easier and it's safer to trade low volatility in this type of market environment, excuse me. You can get run over with some of those momentum names. A couple of these, were down, significant couple of days ago in terms of those momentum trading ideas. Those who are regulars with this will be aware of this. I'll just share it with you. I have a couple of short portfolios, and perhaps not surprisingly, the names are just exploding. One of them is with my friend Barry. What this one does, it's basically the opposite of the momentum portfolio. It's catching sentiment names that are falling below 9. So in other words, they're high flyers, sentiment starts to fade a little bit, and that gets picked up in the Barry short portfolio. This one, just once again, the opposite of the momentum portfolio, except it's picking up sentiment that is weakening, obviously, rather than moving higher. This one picks up sentiment that's moving below 4. And you can see the number of names there. I looked back at the history, and I don't have a huge history in terms of keeping track of the names. I think I had 35 days that I've been tracking the numbers. But over that time, my average for this portfolio is 15 names. In Barry's, it's 18 names. In the last 5 days, Barry's count has averaged 33. My count has averaged 49. So just to give you an idea of the type of market backdrop we have right now, it's heavily favored towards the short side right now. Tim, I'll go ahead and cover my ahead look, and you can say, Brian, you're full of it, or you can add whatever you'd like here when I turn it over to you. Obviously,
deal. I'll try not to contradict you. Deal.
That's okay. That's okay, because it's good to have contrary positions sometimes. Gets us thinking about what's happening. If we look at the setup right now, I mentioned this in today's note, sentiment fading.
Oh, and Brian, to interrupt you just quickly, Ollie asked if you would share the parameters that you use for your short list. Yeah, that's easy to do.
Yep. Let me go ahead and do that. And you guys, no problem. You guys can capture a screenshot of that. I'll go ahead and share both of them. So this is the Barry short portfolio. And once again, one of the key takeaways here is that sentiment is moving below 9. So once again, think of high flyers that are just now starting to fade. It's basically the exact opposite of the momentum portfolio. Once again, sentiment starting to fade. If we look at at my other short portfolio, and I know Tim has one where he captures uh, short volume that's moving north of 75%, I think. And maybe he can speak into that. But if we look at the other one, very similar to what I just showed you, the difference here, you can see that market structure sentiment really starting to weaken. That's moving below 4. And once again, there's a lot of names in that portfolio. Let me take just a second more in case you want to screenshot that. But market sentiment moving below 4. And once again, I think there was 56 names in that portfolio today. So just an awful lot of names. Uh, Once again, tells you which way the market is slanted right now. Sentiment right now moving dead neutral. So even after all of this, so all of the weakness that we've seen, sentiment just now getting to neutral. Short volume continuing to move higher. That's an environment that is convergence rather than divergence. And as we've shared, that's a market that favors shorting rather than going long. Now, there are a couple of arguments that you can make for potentially going long, and let me make them and um, you know just kind of walk through that here for a second. If you look at this is a 1 year look for broad market sentiment. Note where short volumes are right now. We actually saw something very similar back in early February. And we had actually mentioned on one of the demos back then, hey, we could potentially have a little bit of a short covering rally here. Recognize that these are usually very short term in duration. It's exactly what happened. I mean, shorts got covered, and you can see the market actually, moved a little higher for, I don't know, a week, maybe 2 weeks. It was a very short term event. But you can see where short volumes are right now. They're close to highs from the last year or so. So in other words, short volume usually doesn't get much higher than these levels, and we could potentially have a bit of a short covering rally. Recognize that's probably short term in nature, though. This is just not a very strong setup in terms of the overall setup. One other argument you could make for perhaps a short-term rally would be looking at what's happening from big tech. Big tech is essentially fully washed out right now. Sentiment has moved all the way down to 1.3. Now, recognize, even though sentiment has moved down to 1.3, it could stay washed out for a period of time. There's no reason sentiment couldn't stay at 1 for another week. I don't know. If we look at what's been moving the market over the course year to date, look at year to date trading, down about 70 basis points. Look at all the green. Every sector is green. Which ones are red? Well, they're sectors that big tech is part of, consumer discretionary and technology. And so we're getting weakness from the market darlings, and it's really handicapping the whole market. So if you go back to that big tech argument, will tech bounce off of 1? Will we start to get some inflows again and kind of come to the aid of the market? I don't know. It really hasn't happened year to date. That's not saying it won't happen this time, but the setup, I think, is a bearish one right now with 2 caveats. One being big tech, being fully washed out, and one being the fact that we could potentially see a little bit of a short covering rally in the short term from these levels. So I think that was. Oh, and I'll mention one other thing. And this is not edge data, but just recognize what's happening in the market. We're obviously starting to get headwinds that are becoming just headlines that are becoming a big headwind in the market. And even when we get quote unquote good news, it's not having the same effect as it usually does. So headlines, and especially those tariff headlines, we're starting to see them pretty much every single day, and they're starting to impact the market, and we're really seeing that a lot. So I think that was it for me, Tim.
Okay, sorry. I was a step behind. I have some data I wanted to show you. Thank you, Brian. Um, and let me try to make sure I don't forget the things that I want to mention. You asked about the short portfolio. Let me go to that just so I don't forget, so I don't go down some rabbit hole. Bear
Mhm.
with me one moment here. I'm going to close a couple of windows. Did I open that? There. Okay. Okay. I thought that would happen. Okay, so I have effectively three things that I want to talk about. By the way, if you've not done this before, if you haven't joined one of these Market Structure Edge, it's a demo, not really. I mean, it's a discussion group, but the principal purpose is to illustrate how market structure, the regulations and mechanics of the market are are a core thing that you need to know if you're going to successfully trade US equities and manage your risk in longer term portfolios. I use this data. I had, discussions with folks who run managed accounts uh, for me, and I'm a terrible kind of customer for them because I know a lot about this market, and I will say I don't think that we should have more exposure to equities. I've got money to deploy, and I have them sitting on it because it's not a good time. Why would you want to buy now when you have a better price later? And bonds have done well. My thinking is that you want to rotate from one to the other. We'll see. I mean, bonds didn't do well yesterday, but those are monetary factors. But the point out of this is that market structure will, I put in the note Monday, it will tell you everything you need to know really about the equity market. And we say this to public companies too, that it's very important to have an understanding of demand and supply and the behaviors which have different purposes and time horizons behind price and volume so that you can control the controllables. There are a lot of things that you can't, and understand what's occurring. Have a big picture. This is the problem to me with technical analysis. And those of you who are good at it, more power to you. But here's the 75% short portfolio. I use it informationally. This number a couple of days ago was actually higher, was 65, I want to say. It tells me when that thing drops to 30, probably shouldn't short the market. When it's 50 and higher, probably can. And it just gives me a good read. If I were to say, what are all the things that you need to know about the market that market structure will tell you? It will tell you what the broad trends are, as Brian pointed out. SPY is not predictive, but it will certainly tell you what condition exists. And if conditions exist now that haven't existed in a long time and that have recurred during periods that you call, whether it's a bear market technically or just negative conditions, probably the prospect ahead is going to be similar. Doesn't necessarily mean that's the case. But to me, you can look at SPY, you can look at broad sentiment, you can look at your dashboard, and you have a very good idea what's occurring around you. And that to me is what technical signals often will not tell you. It won't tell you whether there is big picture risk, short-term opportunity, but you can sure see it. And this is what I do every day. I will look at this dashboard, and you can see the trends. How do you know when they're going to change? We'll come to that. I'll give my thoughts on what's ahead. I didn't quite finish saying that that's number one. Number two, how do you, Candace, it gets to your question about how would you know in the middle of everything that's going on and the market shoots up and you think, whoa, what direction do you go? I want to address that. And then the mechanics. Well, how do you do what you do every day if you're going to trade things or manage your risk? So let me get to the how would you make bear bets? And I want to share some data with you if I can here. Let's see. I'll give you this view. And it's a lot of moving parts. You don't have to understand anything other than that this data um, will show you periods of time. So what I've done here, and I've got, I'm doing this all the time. Had a meeting with our one of our engineers about a couple of key things that I want to do with these data. This is what I spent a lot of time thinking about. So core takeaways. Isn't this fascinating that the standard deviation of volatility in the S&P 500 collapsed with the pandemic and it's never come back? It's not volatility, it's how much volatility varies. I was talking with a guy on the gondola today he works for one of our big hedge funds here in Steamboat. It's an outfit called Deer Park Management. It's run by a guy, I want to say he used to be with Soros. Michael Craig Sheckman, huge philanthropist here in the Yampa Valley, donates all kinds of money. They're distressed credit investors. And this guy was telling me he built an algorithm and it stopped working during the pandemic. And I shared that volatility ceased to reflect its previous characteristics. Here's what I want to share. These are all things that we derive from edge data. This is SPY into about February 14. So there are two core takeaways from this data. The cycles from periods of gains to periods of volatility used to run in fairly short increments. You could call them, you're going to have some kind of volatility event every year. And it was fairly predictable. These periods, if you just went and you assumed there was a hammock hanging among these things, and they're telling us the volatility of SPY, the buy sell balance in the data, and then just the midpoint of SPY. Then with the pandemic, they suddenly extended way out. So you can say this is, how much greater is this? Well, it's at least 2 times greater, the period of time. And is it because there is more money chasing the same goods? Could well be. So when I looked at this data and we had this, massive volatility event here in December, I looked at it and said, well, what is the probability that one of these events occurs? Well, I don't know, but statistically pretty high, right? So it's why I began to say in December, and I made some bear bets even a little earlier because of rising volatility. Around Thanksgiving, very profitable volatility and short bet. Here in December, I shared with you, I said, I have a big short because I believe that if there has always been offsetting selling and we have not had that, and that we have a hammock style increase in volatility, probably going to happen. And so, Candace, it kind of gets to your point. How would you know in the middle of what's occurring in the market and you have a big run, like, oh, the tariffs have been delayed, stocks go up? Not rational. That is not the way rational people behave. Rational people began protecting themselves in December. That's what showed up. And if you know that this is the condition of the demand side of the market and the supply side of the market, and there's a big spike up in the market, what should you do? Probably short it. And so, that's certainly what I did yesterday. As I, toward the end of the day, um, if the market rises under these conditions, what is the probability that it will give it back? Now, today may be more challenging, but Candace, that's the key. The key is what are the central tendencies? What is the prevailing big picture? And if you have an outlier in the market versus the big picture, now there are times when you have to throw in the towel. But it leads one to conclude that there's a high probability that you can be successful, whatever direction that is. It can be the reverse too. If broad sentiment drops below the green line and you have a weak day, it's probably a good time to be long the market, maybe leveraged, not trade volatility. Volatility has a propensity to diminish as things rise and rise as things fall. Why? The bid offer spread. It's harder to get out of stuff than into it. right? Because the bid and offer will always be lower than, or the bid will always be lower than the offer. And so if the market is declining, man, you get volatility and shrinking trade size. So you have to be aware of that risk. And on the upside, volatility will diminish because it's much easier to cross the spread and narrow it. And so volatility diminishes. So you want to be aware of those conditions. And I bought low volatility. I bought CME, SPG, CAH late in the day. And this was on what's today? So that was late in the day, Tuesday. I sold CME right away. It made it's more than those are low volatility. I just want 1%. Right? And so take that. Today I still had SPG at right shortly after the markets opened, and I've sold my positions because I was going to ski. I realized that the market could give me more return, but you're just happy with that. My 20,000, I only traded $20,000 that was leveraged, and that produced all of those returns. And I sold SPG. I was down a little in it. I only owned a little bit of it, and it wasn't producing a return. You can come, who cares? You can always come back to a low volatility trade. If you've made, against what I traded, 9%, why would you hold on to something? Why do it? Get rid of it. And look, it went down further today. It's an example of something that has gone down well more than its full volatility. And there might be a reason for it, but it's, just get rid of it. You want to, stack the probabilities in your favor. And so thinking about what's coming next, from a trading standpoint, Brian and I talked about, we both are going to put on carefully hedged levered bets toward the close because of jobs data tomorrow. Is there a possibility it could be light? Well, the trailing data, the ADP data, might signal it. I don't know what it's going to be, but I know these conditions say we could have volatility. Now, I don't know if it will be up or down. I would feel better if the market recovered and closed, well off its lows today, that I would probably make a larger short bet. Because again, I'm looking at the prevailing trend. Money tends to follow a central tendency. There will be outliers. It's very volatile, but those are the things that you use to your advantage. In here, you're going to be bet much longer. Hedge yourself short, but much more long than short. Market peaks. Okay, well, now I'm going to diminish my exposure and buy low volatility. Okay, now the market's starting to deteriorate and supply is rising. Now I'm buying volatility and betting long or betting short. Those are the things that you can do all the time based on the data. And so look, I'm not advocating that trading volatility is risky stuff, and you should be aware of that. And you should do it very small to begin because, man, the prices can move on you. Things like UVIX, UVXY, SVXY, those are instruments that you can use for very short windows. But it's a great way if you understand the big picture. Do I sit and look at a screen? No, I don't at all. Last 10 minutes of the day, I'm going to get the reference price. I'm waiting at the open. I did all of that before I left to ski. Just done. And I'm happy, and I will do one more thing for today. That's it. I don't like sitting in front of screens. It's not what I'm going to do. I don't like studying charts. Not going to do it. Don't need to do it. So now let's shift to my view of, and I may repeat something, but I want to shift to what's ahead. By the way, I want to share this too. So here's the low volatility portfolio as of yesterday that we're running, that I want to share. So look, it's up 4.7% versus SPY down some. It's been and there's the portfolio currently. And let me scroll a little bit. So this is what this portfolio currently holds. A lot of stuff. So you wouldn't have to own all this stuff. You could own parts of it. But every day it will say, today it said, buy HONOKE HWM. I didn't look at them, but if you were doing a long-term portfolio, that's what you would do. You would sell Intuit, Booking.com, and Roper Industries. I thought Roper looked pretty good. And so here's and it hadn't done much, but it hasn't lost much either, right? This is up 2%. That's up 1.5%, kind of what you want. And the quantitative model is doing all of that work. It is basically low volatility with some broader characteristics so we get a bigger group. But does it tell us that quantitative data that uses market structure to determine what to buy and what to sell can work? Well, of course it does. We know that works well. Getting to the big picture. there are people talking about I think we were way ahead of this. Looking at this, I was concerned. I said, I think we could have a bear market in the first quarter because of volatility. There are, three things that matter: demand, supply, and volatility. Demand broke down. Supply has been an uptrend. Look at that. And volatility is way up. Well, could the market have real trouble? Yes. If those conditions exist, it's a central tendency. And so, you have to approach that carefully, but it's fabulous to have a great view and a confidence that you understand what's occurring. It sure beats not knowing. So, I'm not pronouncing that the market will tip into bear territory here, or that Brian said, look, we could get some change here in the near term. The market is so heavily dependent on arbitrage among a basket of equities like the S&P 500, some statistical sample of that, the ETFs that track baskets like that, and then the options that trade off of those things. And market makers don't like to lose money. They're very risk averse. So they try to keep those things in alignment. When volatility increases, the volatility of the S&P 500 basket is 3.1%. It's more than 50% over what their models are designed to deal with. So it gets difficult for them. They don't want to lose money. And if they withdraw from the market, whoa, that's when we have trouble. And so again, am I predicting that? No. But there's a volatility event tomorrow. Then you start looking ahead into, quarterly index rebalances and options expirations. If this picture doesn't improve, wow, could be challenging. So you should be aware of that. Be aware of it in your long-term portfolios. Don't, don't take risk in those. And short term, great opportunity to trade volatility. Low volatility can produce returns. And we will know when this picture changes. So I will stop there, and please ask questions. Did I put everybody to sleep? I can understand that.
Tim, you
Dan,
mentioned
Dan
volatility.
Eisenberg, nice to see you. Yeah, say again.
You mentioned volatility in the underlying stocks for the S&P 500. I think you mentioned that was about 50% higher. It's actually over 100% higher for the SPY right now.
There you go.
So everyone's just having incredible difficulty with the arbitrage mechanism, as you mentioned.
And how did I generate that spreadsheet? We are a data analytics firm. That's really what we are. So we have massive amounts of data that I can look at. There isn't almost anything that we don't measure. We measure behaviors, we measure volatility of volatility, we measure all of it, and we could overlay these things. Demand and supply, buy and sell, that's how things close relative to midpoint. We look at that data. It's a factor in the demand algorithm. And Joe, let me get to your point there. So it's a combination of all those things. And behind this, we don't want to. You can go down so many rabbit holes that we could share all kinds of data, but there are things that are demonstrably more beneficial, and we really focus on those. Which reminds me, I wanted to show you one other thing. Oh, do I not have that open? I may not have it open. I don't have it open. I was going to show you the sector demand supply balance, but to answer your question, it's from the many data sets that we track. Joe, let's see, you asked me, why did you get out of your longer term short position and go more tactical? It was a long time, right? It was a long time. It's a lot of risk to take, and I don't like to take a lot of risk. So when I delivered the goods with that, I thought, I'm not going to, because they're not designed for that. When you hold a position in a leveraged ETF for more than a day, already you have decay risk, because they're using baskets that they reconstitute every day, and it will be swaps with someone. And those swaps that they redo every day will have a different value than the one that was backing what you bought the day before. So if you hold that thing for a week or two or three, you risk losing a lot of money. right? And I took more risk than I generally will do because I had a big belief that the data would produce volatility, which it did. Uh, but when I delivered the goods with that, Joe, I thought, okay, I'm not. That's enough taking chances. I'm going to shorten from strategy to tactics, and that worked just fine too. What I did today was a tactic, not a strategy, and it delivered a very good return. That's my answer. Okay. Anything else? Last 10 minutes. I don't look at them, Pam. I can see it, right? I don't need to know anything more than what things do in the last, really, you can see it in the last 30 minutes. Last hour, even. Last hour, there's a great scrum occurring. Last 30 minutes, if somebody's got to get something done, they're trying to jockey their way up the queue, and they're going to try to move the price in the direction they want that thing to go. And in the last 10 minutes, of course, you can't cancel your LOC, MOC orders, limit and market on close. There's exchange rules that won't permit that. So you can have a pretty good idea which way those things are going. But I like in these conditions, put in a limit or market on close. A market on close order can give you, if you've got a long short straddle, you might get the very best prices for both. And it's under these conditions, explosive volatility, declining demand, rising supply, they may give you those things. Non-leveraged shorts, like I started, Candace, with SH because you should. Don't start with something that's 3 times levered where you can lose 10% when you look away from your phone, right? It can happen. Start with SH, get comfortable. It's very liquid. Don't use limit orders with that stuff. Use all market orders. You don't need limit orders with that stuff. And test it. And take a look. Test your thesis. Look, I believe the market has moved. If it's moved up half or more of its intraday volatility and it's going opposite of the demand supply equation that exists, try it. Right? The probability that you produce a return before the close is very high because the market is going to mean revert, and we know which way it's mean reverting. It's going to mean revert lower unless and until those conditions change. So now that doesn't happen every day. Could have variances in the days, but it always come back to the central tendency. That's what Renaissance figured out. Know the central tendency, and you're going to be on the right side of the trade most of the time. And that's what you're using to your advantage. SH is a good idea to start. Get comfortable. Don't go out and I own $15,000 of UVIX, which is an awful lot of an instrument that can move 10%, but that's how you get it. You don't want to hold that kind of stuff. Or 150,000 or $300,000 of something that can move 10% in a day. Whoa, it's risky stuff. Be careful about that. Okay.
How's Edge look on Tesla? Just curious.
Oh, let's have a look. Yeah.
Just curious if it's shorting is having an effect.
Yeah, let's have a look. By the way, that reminds me, I will be on with the pre-market prep guys Monday, 8:30 a.m. Eastern time. Okay, so Tesla. It just makes me think of it because this is what we do all the time there. It's like, look at the supply-demand balance. So it's miserable demand. You could go back and look at this data and see how this compares. The supply side is fine, but it's so weak that all the market makers are out. I mean, if you're at 37%, it's not good. It's not good. You could back this up to see, well, when is good? It could be at 1. What you want to see is a sharp rise in demand. How do you know that it's going to go over 5? Right? That's the problem with how this one right here. This was no good. How can you know? Well, when you have this long window at 1, I don't like that. I want to see it go back over 5. If you do that, you've already dramatically improved your outcomes. If it doesn't get to 5, the thing can keep falling. So, could you short this? If you had this condition and this kind of supply, 67%, I would short it. But at half that supply, I don't know that I would. But it's not a good condition, Barry.
Okay, thanks.
You bet.